Hello and welcome to this ByteTree webinar on the two most important alternative assets in the world, gold and Bitcoin. I'm Kit Winder, the Senior Equity Analyst here at ByteTree, and as always, I'm joined by our founder and the creator of the Bold Index, Charlie Morris. Today we have a fantastic conversation lined up at a point in time when gold is recovering from a brief shock and Bitcoin is suffering alongside the US tech sector. Meanwhile, global money supply marches ever higher and geopolitics is pushing safe havens to the forefront of investors' minds once more. Luckily, we are joined by a brilliant guest to dissect it all, Chris Wood. Chris is the Global Head of Equity Strategy at Jefferies and the author of the widely renowned Greed and Fear, now running since 1996, 30 great years. He's also the author of 3 acclaimed books and is regularly ranked as the #1 equity strategist in Asia Money polls. Thank you so much for joining us, Chris.
Thank you.
Now, Charlie is going to get us started with a pitch on Bold, but before that, it is important to say that none of this should be taken as investment advice. It is for educational purposes only. But with that said, Charlie, over to you.
Thank you, Kit, and welcome, Chris. So we'll get to Chris soon. I know we're dying to get through this presentation as quickly as possible because that's going to be the interesting bit. So Bitcoin and gold, Bold. There's a little risk warning there, which you can read at your leisure. Straight into it, Ray Dalio famously said a few years ago, I would take the gold, I would sprinkle a little bit of Bitcoin into that mix too. What was he thinking? At ByteTree, we've been constructing portfolios along this very simple guideline. Inflation is top and bottom, and risk on, risk off, which is normally in line with bond yields, although not always, is left and right. And so if you're looking for something that's protects you against inflation, monetary inflation, consumer inflation, what have you, then gold and Bitcoin spring to mind. So in a traditional portfolio, we're on the bottom of the line where we have disinflation in the sort of 80s, 90s, noughties, and we like bonds and equities. And these days, things are changing a little bit. Inflation is more of an uncertainty. Gold and Bitcoin make sense. Alongside Bitcoin, you might have financial assets such as banks and insurance companies. You might also have commodities and heavy industry. Gold doesn't have many substitutes, but whenever the US is feeling creditworthy, then TIPS at least used to do a similar job as the gold price. Anyway, so we're putting Bitcoin and gold together to capture the alternative assets on the top of that table. So putting Bitcoin and gold together, we do that using volatility as a very simple measure of risk. Now, a lot of people would criticize volatility as not a complete measure of risk, and indeed it isn't. But what we're doing here is looking at the quality of the asset. So how much the price wobbles in order to get the same amount of value into each asset. If we had $100 and put $50 into gold and $50 into Bitcoin, clearly we stand more chance of making or lose money in Bitcoin most of the time. And so we have less Bitcoin and more gold because gold is less volatile. We use 360-day volatility, which is backward looking and really smooths out the volatility of volatility. So there you go with a dashed line, that's the 180-day line. And that's a little bit crazier. And a lot of people look at 30 and 90-day volatility, which really is all over the place. So we're just trying to check in of where the asset is, how it behaves on a normal day, and that is the basis. But I think it's interesting to notice that Bitcoin was very volatile in 2018 and indeed before then, going to the earlier days. Gold has tended to be pretty stable in the high teens, but recently has been rising. And then the difference between those volatilities is shown in blue. And so the volatility between Bitcoin and gold has been converging for the past 8 years. So we have this very simple index, the Bold Index, which is straight out of a financial textbook. We did not invent this. Our index agent in Stockholm named CIO, they do this for us every month as an independent regulated source. And they plug in the volatility on the left-hand side. So last month, Bitcoin at the end was 32 and gold was 18.7. Then they do some very complex maths, which could probably be done by the average 12-year-old. And then on the right-hand side, we have the weights that come out. Now, the key thing to understand is that if you put the same numbers in on the left, whatever they are, you get 50-50 on the right. But if on the left you put in two different numbers, then the lower volatility asset gets more weight. And this is the same way that most risk funds, volatility funds, are managed. 10 years of the history of the Bold Index. I mean, it's only been live as an investable tool since 2022, but nevertheless, we've back calculated where the volatility differences were. And you pretty much had 25% Bitcoin in the index in late 16, but the volatility took off in 17 and 18, taking the weight down to 10. And since then, it's been building up steadily and is now at 36%. In real life, we can set the asset allocation of our Bitcoin and gold fund at the end of the month, which is what we do. But then real life takes over, and the prices diverge. And on the left-hand side was February, March 2024, the time of the US Bitcoin ETF launches. Very excitable time for Bitcoin. So we had to reduce the exposure at the end of March. And then there was a bit of a hangover in May 24, and we had to boost the exposure. We had to sell some gold and buy some Bitcoin. And every month we do this process of rebalancing at the end of the month. And recently it's been quite vigorous over the last 6 months. But as I'll demonstrate, this process adds quite a lot of value. Quite simply, we're buying low and selling high. That's the 2-year performance of Bitcoin in black, gold in gold, bold in nice royal blue, and equities, global world index, total return in red. Over the past 2 years, Bitcoin has done very well until the last few months, when it's come all the way back down to equities. It must be bad if it's down to equities. Gold's been stellar with very high returns indeed, and gold's been sort of not quite in the middle, but better than that. And it's not just because there's an overweight in gold in the bold index. So let's look at that. Bitcoin's up 44% over the last 2 years, gold 147.8. This is as at yesterday. And the average is 96. Yet bold is 121.8. So there's an excess return of 25.9. So some of that will be caused because the bold is overweight in more than 50% in gold. But we can go back to 8 years. Now I cheekily start this chart at the end of 2017 at the Bitcoin high in December of 2017. And the reason I do that is if I started it any earlier, then Bitcoin's through the ceiling. And so we can't actually have a good look at what's going on. But over that period, I think what's truly fascinating, and Chris will come to this later, Bitcoin and gold, they've had the same return pretty much over 8 years. So however you cut it, one went up a lot and down a lot, the other went down a lot and up a lot. So they had good and bad times with a natural counter-cyclicality. And you've had, an average return of 286, bold 456, an excess return, pretty staggering of 170.4. Why? So the bold index is doing two things. Firstly, it's doing asset allocation from risk. So we're trying to put equal risk in. So on any given day, if Bitcoin's up or down a lot, then hopefully, because they have low correlation, they're going to have some sort of natural offset, which is pretty helpful for keeping the risk down. But then there's another dimension, which is the rebalancing transactions. And rebalancing is about a third each year, between 25 and 40%, depending on what happens in the market. And because we're buying low and selling high, and because we love the assets long term and they're going up, to nip and tuck here and there adds value. And that is shown by the red line. And there's an excess of return in bold of 5 to 7%. Now, if the low correlation disappeared and they became correlated, we'd expect that line to flatten towards zero. But why is sometimes bold much worse than owning Bitcoin and gold, the average of Bitcoin and gold, like in 2020? Well, on a Bitcoin surge, you'd rather own Bitcoin, frankly. If you knew they were going to come, that would be helpful. And on gold surge, like we've had recently, you'd rather own gold and wish you hadn't bothered with the Bitcoin. But nevertheless, there is a trend rate, and that trend rate is the red line. And I think that's the important point to take away. The risk of owning bold as opposed to Bitcoin and gold comes down quite markedly. So we've already shown this chart with Bitcoin and gold, but we now add bold. And the risk for most of the time is pretty much at the levels of gold or slightly above. And in the last couple of months, it's been the same as gold and now, ironically, lower than gold. So and we're seeing that in the ETP against the gold and Bitcoin ETPs as well, over 30 and 90-day data in the market. So that's pretty fascinating that you put these two things together and you don't get the average, which is what you'd get from correlated assets, but you get something completely different. People say Bitcoin's volatile and gold's scary. Well, how about the Mag 7? So we'll start at the top with Nvidia, with Tesla in red, and then pink we've got Nvidia, and then we've got Bitcoin, which is the same as Meta. The income, Google, and the other one slipped my mind. Apple, that's it. And then finally, in the pink at the bottom, we've got Microsoft. So all of them are more volatile than gold and bold. And actually, Bitcoin is midway of Mag 7 stocks. So not nearly as crazy as commonly believed. Another measure of risk is maximum drawdown. Bitcoin, we all know it goes down a lot and then it goes up a lot. Gold, less so, but of course in 2013, 14, 15, gold did go down a lot. And in the 1980s, it also went down a lot. So gold knows how to fall, Bitcoin knows how to fall, but they're both great assets long term. The nice thing to see about gold in that relevant period, the 10 years of data that we have, is the max drawdown has been, with the lesser of the two assets. A Sharpe ratio, fund managers like this sort of thing, risk-adjusted returns. So we've got the compound annual growth over the period stated, the 8-year period. 24 for Bitcoin, 21 for gold, 26 for gold. Volatility of Bitcoin was very high in the 17, 18, 19. That data is captured in that number, so it does look a bit high. Gold looks a bit lower because the volatility has picked up recently, but nevertheless, the average has been that, and gold is 17. And the Sharpe ratio, the risk-adjusted return, for gold is very high indeed. And Chris, something I hope we can talk about in a minute would be the fact that there are 14,000 ETFs and ETPs in the world, and we think that gold has the highest Sharpe ratio of them all. No one's told me otherwise. So hopefully we're going to talk about Bitcoin and gold and say, well, yes, it's great to own these things, but why gold? And the first point is that you bring the level of risk down. Which is always a good thing. So if you get the same return with less risk, that's a good thing to do. But also the rebalancing transactions add value, and that's demonstrated. And if you're going to own both, or you're running other people's money and own both, then it's a much calmer journey to own both than it is to own the two singly, and also leaving the value on the table. And my last slide, I'm pretty sure that's my last slide. It is indeed. That is the world money supply, the M2 money supply, the G20 nations shown in red. And they're different scales, of course, and bold shown in blue. There's a very high correlation. So, when they print the money, it either goes to gold or to Bitcoin. And they sort of keep printing the money with a certainty of deaths and taxes. And yet one of the assets seems to benefit at any one time, depending on the situation. And the lower chart just shows us, the relative performance of those. And so not only do you have high correlation to the M2 money supply, which has been rising, but it does seem to do a much better job of capturing that. So that's me done, Kit. I hope I didn't go on too long.
No, perfect. But now it's great to bring the conversation in. Chris, you have your own asset allocation, which is focused on gold and miners and Asian equities as well, I believe. And that's what I think Charlie wanted to start. So perhaps you could talk us through your justification for that setup.
Oh, no, actually, I started that asset allocation about 2002. It's a long time ago, because my base case was that, my base case was that the US dollar paper standard was, I wasn't going to have a finite life to it. In fact, I would argue that the history is the following. The US dollar ceased to be backed by gold in 1972. So to me, actually, the amazing thing is how long the US dollar paper standard has lasted. But to me, it's on borrowed time. So that's why I originally set up this portfolio, which is for a US dollar denominated pension fund back in 2002. And I started with very big weightings in gold and gold mining equities and Asia ex-Japan stocks. And I haven't changed it very much since. But what I did do in 2020 was introduce an allocation to Bitcoin. And the reason I did it then was because at that point, institutions could buy Bitcoin because custodian arrangements became possible. So to me, it made sense to put Bitcoin in as a sort of digital gold store of value. But I removed Bitcoin a few weeks ago from that portfolio.
So let's talk about that. What's changed in your opinion about Bitcoin?
Well, partly I was just taking profit, but there's two things. One was tactical, that it looked like because I've been following this, which you may not believe, in this 4-year post-halving cycle in the digital asset class. So it does look like Bitcoin peaked at the end of October. on that 4-year post, but that's a tactical call. So that's why I removed it from my global portfolio. But the other reason I removed it is simply because we had this noise relating to quantum. So while I think quantum still some time away, talking to some, theoretical mathematicians, they confirmed to me that this was an existential risk should quantum emerge. And the Bitcoin community started to discuss this. And because it's an existential risk, you have seen some evidence of long-term holders of Bitcoin liquidating. And also you've got this debate going on within the Bitcoin community about whether they should burn vulnerable coins, etc.
Yeah. So let's start with quantum then, because it is a genuine threat to the system. I'm right in saying it's not every Bitcoin in the world that's a threat. It's the early ones, the ones that were mined in 2009 and 10. And so it wouldn't destroy Bitcoin overnight, but suddenly there'd be a flood of new supply from nowhere, which would certainly shake things up. It would be a bit like a meteorite full of gold landing right outside Sharps Bixley and saying, right, come and buy gold here.
Yeah.
So I don't think the gold market would like that much. So I do understand that. But to me, the most exciting thing about Bitcoin is its ability to evolve. And we've had 2 upgrades to the system, Taproot and Sedgwick over the years, which have been pushed in through consensus. And then the other thing that we had was back in 2013 when Bitcoin was starting to become popular. It was very hard to send money, even small sums, to the Bitcoin exchanges of the day. And so the Bitcoin system said, well, let's invent stablecoins and bypass the banking system entirely. So there's been some examples of this thing to be able to innovate very, very, very impressively, how it's just sort of leapt forward and solved every problem that's come in front of it. And I just sense that with the quantum debate, something's going to happen. So it's not something that worries me because it's being discussed.
Oh, no, I'm not saying it's the end of Bitcoin, but I can just see that, and the fact that we've peaked on the 4-year cycle just means we're likely to correct more.
Yes. Can we talk about the 4-year cycle?
Yeah, but I'm still assuming that's for real. And if that's not true anymore, then that's a different story.
So, Chris, look, the 4-year cycle, I think it's being expressed by Bitcoin, but I think it's been around in my whole life. I mean, we think about 4-year cycles, and Robin Griffiths is a good one on this. So we started in 1974, which was a pretty bad year for the stock market. 78 wasn't great either. 82 was the best time in history to buy equities at a low in a recession. And then 86, this is controversial, nothing happened, but the stock market carried on going for another year and then crashed.
Right.
Then we come to 90, Japan started to go funny at that point. But there was also a recession and interest rates. 94, we had the yield curve in America. 98, we had the Asian crisis, which you predicted. 2002, we had the dot-com low. 2006, we had another uneventful year, but they slashed interest rates and printed money and stuff. And then 2 years later, we had a spectacular crisis in 08.
Yep.
In 10, we had Greece and Euro. And then in 14, Bitcoin kicks in, and now we start to see 80% drawdowns in Bitcoin in 14, and light corrections in tech. And then in 18 again, there was a correction in tech in 18, just like there was in 14, and again in 22. And here we are in 26, and tech's not happy, and Bitcoin's not happy. So I wonder whether the 4-year cycle is the halving cycle, or whether it's just something that's been out there for a very long time.
Oh, well, that's looking at more specifically because you do have this halving dynamic in Bitcoin.
No, I know that, and it's a well-flagged story, but I don't see how Bitcoin can wag the dog. The tail can't wag the dog. Bitcoin's little thing, tech's huge, and I just sort of wonder if that that cycle's a bigger story, and then everyone's explaining it because you haven't seen it anywhere apart from through Bitcoin in the last 4 cycles. It's my theory anyway, but
the history is you made a lot of money over the halving, and then it made sense to sell it. So I suppose I'm just following that narrow history as it relates to Bitcoin.
I couldn't understand that.
On the bigger picture issue of the tech, yeah, to me, this is the year, in terms of US big tech, my view has been this is the year when we've had 3 years of what I call the AI CapEx arms race, which kicked off beginning of 23 when that thematic entered the stock market because of Microsoft's purchase into OpenAI. So my view has been that this will be the year where investors start to question the returns or the lack of them.
Yeah.
AI CapEx. So we've just actually seen the first sign of that process starting with the most recent, just concluded earnings season.
And
But I just think it's just starting. That's my point.
No, I agree. I mean, I think we're big tech bears, ByteTree.
Yeah.
Kit, are we tech bulls here?
No, not especially. But I did want to ask, just because you mentioned AI, Chris, whether in your thesis around the quantum computing threat to Bitcoin, whether you'd seen that AI was maybe accelerating the development of that quantum computing, whether the speed of change had accelerated on that front. Is that what concerned you?
No, I didn't. All that concerns me is there's a perception in the Bitcoin community is now focused on this risk, which in the medium term is a good thing because, as Charlie says, they'll probably come up with a way of dealing with it. But in the short to medium term, that raises an existential issue.
No, quite right. And what would you?
So it just means you're likely to buy Bitcoin cheaper.
So that's really what's happening here, Chris. Is you just want to pick up cheap Bitcoins at the end of 2026 from the upside?
But actually, I'm owning Bitcoin as a store of value. So like gold, this is a portfolio for a US dollar denominated pension fund. So if there's any existential risk whatsoever, then it doesn't really make sense to keep it in this pension fund.
No, I can understand.
And I had a Bitcoin ETF in my global equity portfolio. Because my global equity portfolio only has one US stock in apart from the Bitcoin ETF. But I originally put that in when it was what was it called? When it was Grayscale, trading at a discount. So I put that in because I heard that I was correctly informed that the SEC were going to drop their case on Grayscale, which meant that it went from discount to par. And when the SEC dropped their case, that was the signal that they were going to allow the ETFs to happen in the US.
So you read that well, Chris.
I'm just taking a profit on the position in the global equity portfolio.
Fabulous. I'm very impressed. You've been good at this business, haven't you? I mean, GBTC was on a 50% discount to NAV before the US ETFs launched, if anyone's out there didn't know that. And so what Chris has done is not only got the Bitcoin return of multiples, but times it by 2 once again. As that.
But the key point was you had to read the judge's case, the judge's summary when they were getting it, and apparently made it clear, at least I looked at it, and it made it clear that the SEC didn't have much of a case. And therefore, once they dropped that case, then the way was open for the ETFs.
Fabulous. And now they're here in London, and they're all singing and dancing in many countries, and more countries to follow. And I mean, what would you be looking for before you're bullish on Bitcoin again?
Oh well, I think one goes down, but I think the other question is: does the Bitcoin community come to a consensus on how to address this issue?
Yeah, so you'd be looking to see that, and you'd be looking for the cycle to turn up.
Yeah, because on the normal 4-year cycle, you'll be looking to buy Bitcoin later on this year.
Absolutely.
But but there is this additional issue. So I just think this perception of an existential risk is a negative. Because I look at Bitcoin as a store of value, whereas I look at the other crypto assets like Ethereum or Solana. These are basically tech protocols, and they're going to either work or not, depending on how much they're used.
I think you could be writing our research here at ByteTree, Chris. I'm sure yours is better than ours, but ours is much cheaper. So that's
no. So that's an entirely different thing, right?
Yeah, they're quite.
But I think it's also very interesting. The guy running Tether has been buying all this gold.
Well, let's move to gold. I mean, you're pretty bullish. Your asset allocation is 70% gold and gold mining shares.
Yeah.
Let's not beat around the bush.
But but Tether is buying a lot of gold. It's obviously been a big driver of the gold price. So the interesting question is that, because Tether's probably made more money. Tether's probably the most successful business model that's appeared in the last 10 years. Tether's the biggest beneficiary of Fed tightening because they suddenly earned an interest on all these dollars they were holding. And so the fact that he's buying gold so aggressively does raise some questions. Which does he prefer best, Bitcoin or gold?
Well, they're diversifying, aren't they? They made their money out of Bitcoin, didn't they? I mean,
Yeah, that makes total sense for them
yeah.
to diversify.
But okay, what about the thesis that Bitcoin and gold work in partnership, and if you're a long-term investor, they fit well together, have natural low correlation, that sort of thing. What do you feel about those arguments?
It's obviously made total sense as you highlighted, Charlie. Yeah. And it is a store. So the only issue is, do you believe it will remain a digital store of value?
Yeah, I mean, so my take is that if you can time Bitcoin and gold, well, good luck to you. There's probably no better thing to do. I mean, we all know the Dow Gold ratio has been one of the great trading pairs of all time. If you could buy it at 1932 or whatever, and buy gold in 1929 and buy the Dow in 1932 and all that sort of thing. If you got those switches right, I think I once did a piece on it, but it's such a long time ago, I've forgotten. But a dollar turns into $1 million or something if you got those switches perfectly right, and if you got them perfectly wrong, your dollar goes to less than a cent. But I think the Bitcoin gold pairing is even more spectacular than the Dow Gold's pairing.
I know, I agree, and it's worked very well. The problem for most of your audience, they weren't able to buy Bitcoin for many years, I think, in the UK, right?
Yeah, that's correct. Well, funny enough, the retail platforms allowed people to buy the Swedish Bitcoin ETP by CoinShares. It was called CoinXBT from 2016 or so to 2020. Then it got banned on the retail platforms, and now it's become unbanned. But that unban is now working its way through as everyone's trying to figure out whether they're allowed to own Bitcoin or not. So regulatory wise, it's still a bit confusing and complex. And there are other issues that the platforms have to face, which I don't want to turn this into a regulatory thing, but basically every week is better than last week in Bitcoin regulation in Europe, I would say. It wasn't always true, but
yeah, well, that's good because it was crazy how long it took.
yeah, absolutely. And you can now buy a Bitcoin ETF in Hong Kong. Still can't buy one in Singapore or Japan or India. These are your markets. What's the view in Asia?
In Hong Kong, Hong Kong has no problem with Bitcoin. Yeah, India, I think, does, and China. So. But Hong Kong has an active crypto community.
Yeah, but Singapore's still persona non grata, but Australia's in, and Thailand's out. So you look around and sort of try and sense, where we're going to see this. Bitcoin traded as actively as gold in all these different countries, and you feel we're moving forward, but slowly.
See, Tether originated in Hong Kong. That's where it began. But obviously, the stable coin is a potential, from a Chinese standpoint, the stable coin is a potential risk to the closed capital account.
Yes.
So the Chinese were going to launch a stable coin. Well, they have announced a pilot scheme, stable coin, because obviously stable coins don't have to be US dollar denominated. So there's a pilot scheme to launch a Hong Kong dollar stable coin, but for some reason it got put on ice a few months ago. So that's something to monitor. Because the Chinese definitely want to be familiar with their technology, but they also understand it's a risk because obviously the closed capital account is a key part of the PRC fortress.
Yes, absolutely. And they want to have a great firewall on their money system as they do on their data and information.
Yeah, well, if Hong Kong didn't exist, you see, Beijing would have to invent it because Hong Kong serves this very important role as a conduit to the outside world in the context of the closed capital account.
Yeah, that is crucial. And it's amazing how, I'm a Hong Kong, I was brought up in Hong Kong, and it's amazing how the country or the territory keeps reinventing itself time and time again.
No, Hong Kong is fine. It's reinventing. The Hong Kong residential property market bottomed about a year ago, last March, April. The Hong Kong property stocks are off the bottom. Hong Kong's fine, but this and the Chinese are doing everything to support Hong Kong. But this issue of the stable coin is something to keep focused on.
Yeah. Well, the stable coin, of course, it's one of those philosophical differences because in America they say it's nothing to do with the state; it's a private sector role, and all the big tech companies and all the banks want in on it because they all realize it's the closest thing you get to a free lunch in life if you can have a whole load of stablecoins that earn interest on other people's money. And in Europe and the European Union particularly, and China, they're much more into the idea of a state-backed digital currency, which is
That's right. But what I'm not clear on, Scott Bessent wants obviously to promote the stable coin in the US and as a way of funding the fiscal deficit because they're backed by short-term treasury bills. But the key question is why should ordinary Americans want to put their dollars in stable coins if they're not earning an interest?
I can answer that question very easily. It's no different from cash. I mean, if you had cash in your pocket, you're not earning interest. So a stable coin is digital cash. You don't, and that's.
But they're only going to go into a stable coin if they want to punt crypto assets, in my view. So if it's a crypto bear market, that's a problem for Scott Bessent's ambitions.
Quite possibly. But I think the other use of stablecoin is offshore gaming, and there's also some trade finance in the shipping industry and that sort of thing.
No, obviously, if you're in Venezuela or somewhere and you need access to stable coins, are very useful. They have a practical function.
They absolutely do. And there was we had a guy who used to send us photographs from Turkey when their inflation was extremely high, and there was a gold souk, and people weren't buying the gold, ironically, and they weren't buying the Bitcoin that they could have bought there, but they were buying the stable coin. It's one of the dollar, and it's weird to think that in this day and age, in some countries you can't buy dollars, but it's true.
But the noise on the US doing the stable coin and promoting it, that sort of died down in recent months.
No, absolutely. So I mean, bring it back to Bitcoin and gold. I mean, where do you think gold's going? I mean, it's your biggest allocation.
Well, see, until this crypto thing started to hit, like crypto quantum fear, I had a very simple view that the baby boomers were going to buy gold, and the millennials and younger were going to buy Bitcoin. So I was saying to gold bulls, boomer gold bulls, that you had to own some Bitcoin because there was a demographic issue about whether millennials, whatever the people under millennials are called, were going to buy gold.
Yeah.
So I looked at it more demographically.
Well, it's been a good play, and
that risk still exists actually for my taking out Bitcoin.
So what do the youngsters do now if they're worried about quantum?
Well, that's the interesting point. But I just think, but obviously gold's move. Now, gold could have peaked here, but my base case it hasn't, because my base case is that it's coming back into the monetary system. Because when I last checked the data, it was about 3 weeks ago, the data suggested that central banks now own more gold than treasury bonds.
Yes, and I published a chart a couple of weeks ago. I think global central bank reserves are 13 trillion, and gold as a part of that reserve was always 70 or 80% pre-1971, and is now, was it in the 30s, isn't it?
Yeah, so that's pretty amazing. So I think the way to look at this, and I'm not saying, no one's saying the US dollar has been replaced. What we've got the incremental, we've got a de facto gold standard incrementally occurring.
Yes, and I think that to my mind, the most interesting bit about the new gold standard is no one wrote it down. The World Bank and that lot never told the non-OECD central banks to buy gold. They came to that decision on their own, and that is truly fascinating. Central banks were selling gold to 2009, and in 2009 they went, my gosh, something's changed. Maybe we need to increase it again, and they've just been increasing it ever since. And since 2022, at an even faster pace.
Yeah, the real trigger, well, the real acceleration happened with the freezing of Russia's foreign exchange reserves.
Yeah.
Now, if you read this sort of British press, that doesn't seem like a big deal. It seems entirely normal to seize their foreign exchange reserves. But obviously, that development clearly shocked people globally.
No, absolutely.
So central banks outside G7, have been increasing their gold purchases ever since. Obviously, the rate of purchase is slow, but it's still ongoing. So I think the way to look at it is that we're entering a de facto gold standard, and we really have no idea how much China has of gold.
Yes.
People who are claiming to know, I think you should, There's no really, you know, they've got more, I'm sure they've got more gold than the official data suggests.
But the multiples, we have no idea, right?
No.
No idea.
The interesting on the gold mining stocks this year is the gold mining stocks were massively trailing gold in this since the gold price took off in 22, and they basically played catch up with the bullion price, I would say, in the last 9 months.
And because they never really believed it, did they? Because
No.
it's fascinating looking at the speculative flows into gold. Until very recently, there weren't many. I mean, people were dumping, the ETFs were seeing outflows in gold mining stocks, even to a few months ago. The inflows into the gold bullion ETFs only started a year ago, but the rally's been going on for much longer than that. Even in silver, it wasn't that bad. But it was all these funny derivatives and 3x products and stuff that seemed to come to the fore in the last few months that really caused the crazy volatility. And I have to say that did catch me unaware. But the thing that is most interesting about the correction we've had in recent weeks is that gold's corrected a tiny bit because there's this huge bunch of central banks sitting there catching it. And silver and Bitcoin don't have central banks buying them, so they've just come down much further.
Yep.
And that is a very, very important point to understand for people in the liquid alternative asset sphere.
No, silver's always been very much higher beta, right, to gold.
Yeah, yeah. But I mean, I think that even if you go back to 2013, I mean, gold had an impressive fall, but you just this time it just seems to be there's a big safety net, and it's not the Greenspan put or anything like that this time. It's a lot of central banks, queuing up and disagreeing with each other. They're not going to coordinate a fixed gold price. They're just going to accumulate.
No, they're accumulating, and also it's the practical reality is you have got these geopolitical issues now, which are real, but it's impossible for financial markets to discount this geopolitics. And obviously, it's made sense not to sell anything because of the geopolitics, because it's obviously a small but not zero risk. But the only practical way to hedge the geopolitical risk is by gold, in my view.
Yeah, and that's
Or
been
maybe oil too, to be fair.
yeah. Although oil has been as bad as Bitcoin in the last few weeks, hasn't it? Or the last
Yeah, because people are thinking that Donald Trump's not going to follow through on his threat to Iran. But the point is, and he probably is not going to follow through. But it's not a 100% guarantee.
No, absolutely right. But there has been an extraordinary divergence because I think I used to think that gold was the sort of daddy in commodity sphere. Other commodities lagged gold by, let's call it 1 to 1.5% per year because of human ingenuity in extraction techniques and so forth. And so gold was the investment and everything else was cyclical, but they were all basically somewhat correlated. But this cycle, energy is down there and gold's up there, and the connection seems to have broken.
Now, well, that's obviously great for gold mining stocks because the energy is so cheap. But personally, at this point, I think to me, it makes sense to own a few boring old oil stocks because we're at the bottom of the range. They're paying out there. I view these oil stocks now like energies, not energy, tobacco stocks. They can pay out good dividends.
Yeah.
And and they're also a hedge on the geopolitics.
Well, ByteTree, we've got a tobacco stock, we've got a few oil stocks, haven't we, Kit?
Yeah, we do indeed. Always waiting for the next.
Yeah.
Uh,
I personally wish we had a few more oil stocks. But then the readers, sometimes our clients, they get upset if we buy tobacco stocks. They write in. So you have that to contend with. I mean,
right, but I think the interesting issue is, will the oil stocks turn out to be like the tobacco stocks for the last 20 years?
well, they have been, but they seem to have got through it.
Yeah.
And the amazing thing about the oil stocks is they had a huge oil price in 2022, and they made lots of money. And here we are a few years later, and their free cash flows are now back to those levels despite a lower price, which just shows the extraordinary productivity gains that's been going on.
Well, the good news is obviously they've reversed out of, some of them were sort of either suckered or forced into pursuing this renewable agenda, which they had no competence in. And so obviously that was a problem, whereas at least the European guys went down that road, whereas the US oil companies didn't.
Yeah, so that's definitely another factor. but of course, on the renewable side, I mean, back to Bitcoin, some of the Bitcoin bulls would highlight its usefulness because if you have cyclical surplus energy and you can't store it because there's no battery big enough, then you can mine Bitcoin and you can monetize it. And that's been one of the sort of pro Bitcoin arguments. What do you think of that?
But the bear story on Bitcoin now is the miners aren't making money.
Well, that's because the price is a bit too low.
Yeah.
But the thing about the best thing about Bitcoin is it fixes every problem, as I said. So if you have if the price is too low, then miners drop out, the hash rate comes down, it becomes easier to mine, they make money again. Everything about the way the system is designed is self-correcting. You know,
So
do you remember when the miners crashed out in April 21? Sorry, go on.
We'll guess at where the bottom is, Johnny.
I think what everyone screams, and the FT did a very good job over the weekend. There was a very funny article written saying the price of Bitcoin was 69,000, and it came out from FTI Alphaville, and it said the price is 69,000 too high.
No, I saw that. So actually, there is you know, there are some. I'm an ex-journalist, so some of the copy on Bitcoin in the last few days is a sort of, I have to admit this, is the sort of coverage you would expect at the bottom. Because what's happened in the last few days is that people who've been upset that, you know, they never made any money in Bitcoin, and then they all know people who made a lot of money in Bitcoin, are now writing these stories. So that FT article is a classic example of that.
But the best bit about that article was that the price went to 70,000 over the weekend. So they changed the headline to Bitcoin 70,000 too high. And there was some comedy there. I didn't realize you could change your headlines because the price moved. I think, Kit, we need to start doing that at ByteTree. With our price targets, just regularly change headlines.
You would never find the FT running a bullish article on gold at any time in the last 20 years.
No, and there's that hilarious one from the 90s, which gets dragged out on Twitter every now and then, which is.
But the other issue for gold we have to keep in mind is will BES and US Treasury decide to revalue at some point the gold?
How does that work? Can you explain how that would work?
Well, it's an accounting thing, right? But they could revalue the gold they hold. I've forgotten the number of ounces now.
So they just say gold's not 5,000, it's 50,000.
Well, it's valued something like what's it valued at $32 or something. So it's
that one. Are you talking about? Oh, yeah. So, okay, fine. So they make a couple of $1 trillion that way.
Yeah. So Scott Bessent, you see, has made a reference in several months ago to potentially monetizing the balance sheet. So
and do you think that matters if they change the price of gold on their books from 32 gold standard era to the present day? Does that make any difference to the world?
They could theoretically buy back a lot of their debt, couldn't they? When I say they, the Treasury.
Yeah, I mean, to my mind, it's just it's pretty obvious that it's worth $5,000, not $32. But
yeah, but theoretically, it would take room on the balance sheet to buy back the Treasury debt. But I think this story is now in the it's now in the mind of the market because it's clear that Bessent understands it.
Well, that's it. And you've got a hedge fund guy in charge, and a very good one at that. And I'm not sure if that's good for the general public or is it good for markets? What do you think?
Well, it's a reason to keep owning gold. That's what I would say. I'm not, because it's in people's consciousness. Now, what would kill gold quite clearly is if the new Fed chairman, Mr. Walsh, turned out to be really hawkish. Raised rates, more importantly, massively shrunk the balance sheet, Fed balance sheet back to 2008 levels, then you would have a huge rally in the Treasury bond market and the dollar, if that really happened.
Yes. And I've always said that the biggest risk to Bitcoin and gold is they balance the books and have fiscal prudence. And it's, I don't know how you'd win an election doing that in this day and age.
No, well, the market's clearly given up. People have given up on that happening, and so there's no evidence in the G7 world they're really capable of addressing these welfare states, etc. So I think the market's given up. But I'm just saying, if that started to look like that could happen, that would be very dramatic.
No, it would indeed, and it is the bear case because going back to my 4 boxes, that's basically saying we're going to an inflationary, uncertain regime, back to a Goldilocks environment. And a Goldilocks environment loves growth stocks and government bonds and credit and all that. So that would be a regime change. But of course, all of those things don't exactly lend themselves to an environment that moves to higher bond yields and uncertainty. And we've already had a lot of that. But I find it very difficult at the moment to have a clear idea whether the US 10-year yield is going to be twice as high in 5 years' time or back to zero. And there are plenty of people out there who are very clever, who can espouse both arguments.
Well, I've got a very simple view on the Treasury bond market. There's no point people, my view is very simple. We had a 40-year bull market in Treasury bonds from 1980 to 2020, and that bull market ended in 2020 when they printed all the money in the pandemic. They paid people money to do nothing. And I think we're now entered a long-term bear market in Treasury bonds, and the only issue is whether they will artificially hold the yield down. So what's interesting right now is how the volatility on the 10-year has collapsed.
Yeah,
so it's looking like they're managing the long end to me. I can't prove it to you.
No, of course, but it's a bit fishy, isn't it? And no trend seems to follow through. But surely that would show up in consumer prices if they keep it down.
No, well, I think it's good for equities, right? So long as the bond vol is so depressed, it's good for risk on assets, and it's a reason to own gold and be short the dollar.
Yeah.
So the reason to bet on that, actually, but if you have an equity portfolio, it makes sense to. A good hedge is to buy vol on the fixed income, because the move index, the fixed income equivalent of VIX, has collapsed.
Yeah.
But my simple point is, there's no point your clients owning Treasury bonds, government bonds. Nobody should own G7 government bonds. If you want to own bonds, you have to own long-term bonds in the G7 world. You should own the best corporate bonds, be it in the UK or the US, with the best balance sheets. And in my view, they will in due course trade through the government.
And not inflation-linked bonds.
I don't know anything about inflation-linked bonds, so to be fair. But the other day, the Louis Vuitton 10-year traded through the French 10-year.
Yeah.
Microsoft 10-year. I'm just saying the yields will go below the government at the long end.
So the best credits in the corporate sector will be more liquid and a better bet than
because these corporate balance sheets, you may not like them as equities, but these guys have fortress-like balance sheets.
Yeah.
Relative to the federal government. And when you go to messed up emerging markets, it's often been the case in the past that, corporate bond deals trade below governments. So when Milei first came into Argentina and started cleaning the place up, when he entered office, I was in BA at that time, the best corporates were trading 1,000 basis points below the government.
Yeah.
So this can happen.
Well, you've seen it. I mean, you're the Asia guy. You've seen more crises up close and personal than.
But the irony is, of course, that the emerging market government bonds have been massively up. The local currency emerging market government bonds since March 2020 have massively outperformed G7 government bonds in US dollar terms.
Yeah.
Because they've basically run much more orthodox monetary fiscal policies than G7.
Yeah. I should have another look at that.
I'll send you a chart. So if you're a finance minister or a central bank governor in an emerging market, you operate on the assumption that unless you behave in a reasonably orthodox fashion, you risk a buyer's strike. Whereas if you're a central bank governor or a finance minister of a G7 country for the last 10, 15 years, you've been operating on the assumption that you issue risk-free bonds.
Yeah.
But the idea that G7 government bonds are risk-free is based on convention. It's a nonsense.
Yeah, and we pointed out recently that Malaysian 10-year yield was below the gilt yield. And I think that's a free market.
No, that's entirely free market. The Chinese 10-year, yeah.
So that's yeah. I mean, basically, you're making the point we live in an uncertain world, and you make a very good point that gold is the natural beneficiary of everything that's going wrong.
That's right.
and Bitcoin ought to be, but there's a little headache to do with quantum, and the cycle's unhelpful.
Yeah.
But if they sort the quantum out, and later this year when the cycle turns up, and it may have already capitulated given some press comment, then hopefully Chris Wood will be back, and Bitcoin will be back in your model portfolio sometime in 2026.
I would say to your audience, the single best reason to buy Bitcoin today was that FT article at the weekend.
Yes. And would you tell us, please, when you do buy Bitcoin?
Yeah, but I still own some Bitcoin personally. I should add that.
Okay, good. Okay.
Obviously, I've sold some Bitcoin, but it's not like I have zero exposure to Bitcoin.
Yeah, fine. Kit, do you have anything you'd like to ask Chris?
Only one thing. I mean, I could ask 100 things. It's all been so interesting. But you talked about how Bitcoin was not yet available to investors in the likes of China and India, but they're obviously huge markets for the gold purchases. And a lot of the story in the last few weeks has been all the gold demand out there. Why do you think it is that they're so permissive and encouraging of that gold market, but not of the Bitcoin yet?
Oh no, you're right. Actually, where there's to be one risk to gold, where there's been real speculative appetite for gold, actually, is precisely where you just said China and India recently. It's suddenly become a very hot trade. In India, it wasn't hot at all a year ago. No, the Chinese government's cracked down on it because of the closed capital account.
Yeah.
You've got to remember that the closed capital account is the absolutely key part of the PRC way of governing.
I mean, so they've banned Bitcoin not because Bitcoin's crap, because it's too good.
Yeah, but it's not like but on the other hand, they're fully aware that the Chinese are smart, so they're fully aware of the technology, right?
Of course.
And they want to be totally on top of it. That's why they've done this stable. They were very quick to do that digital currency in China, and that's why they've got this pilot experiment for stablecoin in Hong Kong. But what I need to check is why they're sitting on it.
Because of course, if you've got a stable coin, then states in control, which they're not in control of Tether. Although they did intervene in some Tether recently, the US Treasury, didn't they, with a baddie, I believe.
Yeah, well, Tether could have been shut down by the Feds at any point in the last several years.
Yeah.
But the interesting point is the guy running Tether has very smartly sold a stake to either Cantor Fitzgerald. I mean, Cantor Fitzgerald hold a lot of his treasury bills, and it was either Cantor Fitzgerald or Lutnick who's bought a stake in Tether, so that basically has brought protection to Tether in US jurisdiction.
It's an honourable world we live in, isn't it?
Yeah, but I think Tether is an amazing successful business model, and it's very interesting that he's I mean, his the Tether buying of gold is going to put it up there as one of the biggest drivers of the gold prices, as well as the central banks.
Yeah, 20 billion, we think. So, Chris, I think we've sort of been through, and thank you very much for everything. Do you have any final thoughts?
No, I think the bold portfolio makes a lot of sense. If you say you're selling high, buying low, so that's a good discipline.
Well, it's a top secret investment strategy. Don't let anyone know.
But obviously, it's one hard for human beings to implement.
I know it is. That's why I have a computer to do it for us.
That's very good. Very good.
Thank you very much, everyone. Thank you, Chris Wood. Thank you, Kit. And until the next time.
Thank you.